Okay, so far in the report we've dealt with how things have performed in the past. Let's now have a stab at trying to predict how things might play out in 2011, and more importantly, give you an idea of what we, as the managers of your money, are going to do with that money in 2011. It only makes sense to have a view on any asset class, but certainly an asset class like prime London residential property, unless you have a very clear view on the core macro environment within which you will be operating. What we believe is that the UK interest rate will be the right interest rate for the UK as a geographic entity, but the wrong interest rate for London. The London economy is booming. There is enormous inward investment, enormous employment growth. All the surveys that are currently being commissioned are showing finance directors and others saying that they will be taking on extra staff in London. You have people being relocated from across the world into London as overseas branches have been closed down. All of this has meant that the London economy is growing at a much, much faster rate than the rest of the UK economy. So the interest rate that is prevailing for the UK will be too low for a London economy that is growing fast. And in an environment where you have a low interest rate and real economic growth, you normally get asset price inflation. So our forecast is that for the next year at least, and probably for the next few years, the interest rate in the UK will be too low for London, and that will lead to asset price inflation amongst prime London property prices. In addition, rents are starting to rise really quite quickly now in prime London. Rents always lag capital prices in any recovery property cycle. For the last 2 years, we've had those capital prices increase. Rents were pretty static. Now what's happening is that rents are starting to rise. They probably rose 5 to 6% in the second half of last year. We believe they will rise a further 10% this year, and that is a consequence of this employment growth that I've already mentioned, and a real chronic shortage of available rental stock. So the combination of steady rising capital values and rising cash rents is obviously a very attractive proposition for any investor into prime London property. We, as a fund, we will take advantage of that in two ways. We will be lifting our gearing. At the moment, the fund is geared 20% to our loan to value to our total assets. We think that's too low for this time of the cycle, and we will be lifting that to nearer 40%, which is the long-term average for the fund. Now, 40% is still a very modest level of gearing for most total return property funds, but we believe it's the right level at this point in the cycle so that the fund can get into its ownership really good prime London property assets which can then be rented out to take advantage of these rising rents. New equity that comes into the fund will also be deployed into acquisitions, refurbishments and lease extensions. We will continue to carry between 5 and 10% of the net asset value of the fund in cash. We have been carrying over 15%, so we will be drawing down on those cash reserves. But there is still plenty of liquidity in the fund. We have never had to suspend or defer redemptions, and we take that very, very seriously. There's one other thing I should mention, and that is the level of sterling. A lot of property investors and a lot of property analysts were very slow to understand the significance of the level of sterling in 2008-9. We forecast, and we were probably alone in forecasting in 2008, 2009, in the depths of the financial crisis, that prime London prices would snap back very quickly. And we forecast that. because we understood the sensitivity of prime London assets to sterling's exchange rate position. Prime London assets are principally bought by overseas investors, investors who are denominated in Swiss francs, euros, yen, and of course US dollars. So the level of sterling is a very important part of any consideration on the likely performance of prime assets. We believe that for the reasons we've given, UK interest rates staying low, UK headline inflation likely to be high in relative terms, that sterling is unlikely to go above its 10-year average for either the Swiss franc or the US dollar or the euro. And in fact, our basic forecast is that by the end of this year, the sterling against its basket of currencies will be at where it is or a bit lower. Meaning, again, cutting out the jargon, meaning that London assets will remain cheap for overseas investors. So the combination of all of these things, we believe, makes this an important year for investors in prime London property and an important year for this fund as we try to grow assets under management, and we believe that we should, by the end of this year, go from something like £25 million of funds under management to nearer £40 million of prime London property under management.